So why hedge commodities? I mean, I guess you know better because like what happened in 2020 and 21, the prices went up, up, up. This is just an example. And that time it was highly possible to protect yourself by hedging. So you may have a customer contract where you have a fixed price which you'll be receiving, but your raw material could be linked to commodity prices. And if the prices go up, you will have difficulty. So this is just an example. Similarly, for an if you're an automobile company, you are an OEM manufacturer, you will possibly be buying aluminum, copper, steel, and if those prices go up, your cost will go up. And it may go up so much because the commodity prices are very volatile. So it's extremely important to protect yourself from the same. If you're a trader or a seller, then you need to protect your margin, and that's the reason you may be looking to hedge. Not always it is possible to have long-term contracts with your buyer or seller, with your counterparty, and hence these markets are important, financial markets. With liquidity, you can have a contract to protect yourself. This is something which you can do. Also, it is not difficult to hedge. One of the reasons why many companies are not hedging commodity risk is because they believe it is extremely difficult to hedge. But it's actually not difficult. It is as easy as you hedge your forex. Maybe a little difficult than that, but it's not very difficult to hedge commodities. And the commodity moves are very sharp. It moves up by 100% up, 50% down. So in such a situation, it is important that you protect yourself. This is just an example. This company called Samsung Resources, they went bankrupt because of when oil price crashed in 2014-15, they are a seller, and suddenly the oil price crashed and their cost didn't justify. They went bankrupt. There are so many examples of companies going bankrupt if they are not able to manage the commodity prices properly, and hence hedging is important. LME has a contract on steel rebar, which has a decent correlation with the Indian prices. I mean, not like the best of the correlation, but best amongst the lot. And then you have a steel scrap, LME steel HRC contract. So there's a HRC China, LME steel HRC China. This has the best correlation with Indian prices in amongst LME. So these contracts are all cash settled, lot size is 10 tons, up to 15 months. There are monthly expiries, prices are quoted in dollar per ton, overall margin, initial margin plus various margin standard. This is the way you can hedge. This is LME steel price curve. You can see that there is a backwardation, like the current price is 637 and the long end is on the lower side. So the prices are still a flat curve, not too much of backwardation in the initial month. Very far end there is a bit of backwardation. Prices are obviously has come down and then are now kind of stable prices. I will just show you the CME contract also. There's a Shanghai exchange, but very difficult to deal in Shanghai exchange. I mean, you need to have that confidence to deal in China. Shanghai exchange, the price correlation with the Indian market is the best, better than the LME and Chicago Mercantile Exchange. So you can also deal in SHFE. It is possible. There is the contract specification, but you can deal. There are some entities are trying to offer, like from Singapore or from London, to offer you a mirror product of the SHFE product. So you can protect your price with mirror rate. CME has 5 contracts. This is the most liquid one. US Midwest HR CRU. This is the most. This is a liquid contract, most liquid contract. But this contract, the correlation is not it's close to 80%. So you have to manage the volatility. I mean, it's not like a perfectly correlated. So it requires a bit of careful management. You need to keep an eye on the tax laws between India and US, how it works.